Hello and hello. Welcome to this free training on the right way to trade options. Today, we're going to be talking about how to sell options. We're going to be covering both cash secured puts as well as covered calls. And we're also going to introduce you to multi-leg options, specifically looking at vertical spreads and credit call spreads and credit put spreads. So I want to welcome you all to the chat. Thank you so much. And what we're going to do before I get into some of the details on how to actually sell options and make money by selling options, what we're going to do is go over some of the basics. Because there's a lot of people that are going to be watching this training. Over 1,000 people total are probably going to watch the training. And I want you guys to know and understand the basics on how to do this so that when we get to some of the more complicated stuff later today, then you're not going to be confused. So before we get to all the basics, please make sure you hit that like button. And if you're not already subscribed, go ahead and subscribe. By the way, a lot of people have said that they are subscribed, but they're not getting notifications of my videos. Make sure on YouTube, next to that subscribed button, click the bell icon and then click all. And that will ensure that you actually get notified when my videos come out. If you don't click the bell and you don't click all, you won't get the notifications. Subscribing really doesn't do anything unless you click that bell icon. Okay, talking about the basics. Let's start with the ultra basics. First of all, welcome everybody. Nick, Sherry, Chris, TJ, thank you all so much for joining this free training that we're doing today. Welcome. If you guys have any questions throughout this training, throw it into the chat and we'll try to get to it. And let's start with the basics. The very basics is really your mindset. And when it comes to your mindset, what ends up happening is a lot of people treat the stock market like a casino, unfortunately. Now, this obviously is not good. The stock market is not a casino. It can be, obviously, if you want it to be, but that's really not what it was designed for. The stock market was designed to invest in companies that are growing, to help those companies get money by selling shares, and to help investors grow their portfolios and retire by taking part in companies that are growing. But thanks to leveraged items such as futures and options and leveraged ETFs, we are now able to expand our profits and grow our portfolios even faster. But of course, with that increase in the ability to make money, there's also the ability to lose money a lot faster. So keep that in mind, that just because you have the ability to make money a lot faster, that also means you're taking on a lot more risk. And with higher risk, well, comes the chance for higher losses. Well, let's pull this up. I want to go through and do like a little chart for you guys to kind of show you this. And I'm just going to draw this out here. So imagine if there was a chart, you know, your typical line chart like this. And over here at the bottom side would be, let's call it profits, right? And actually, there is a text thing on here. There we go. Okay. So profits. And then down here, we're going to do, this is going to be risk. And what ends up happening is when you guys are down here, low risk, low profit, this would be something like investing at a bank. Let's say you were going to invest, just throw your money into a savings account at a bank. You might make, you know, what are they paying right now? Like 0.1% interest, right? Ultra low risk, but also very low return. Now, you could possibly take on more return. Let's say you put your money into a regional bank and, you know, an online bank or regional bank, they might give you as much as 5% interest. But now you're taking on a little bit more risk and the possibility that the bank might collapse. You might not get access to your money. So with that increased risk, well, you also have an increase in a return, but you also have an increase in the possibility for a loss. Another thing that pays around 5% would be government bonds, things like treasury yields. Government bonds, treasuries, those pay around 5%. You're pretty much going to get 5%, but you are taking on the risk that the government collapses, that there's a default. And then you even have corporate bonds, which could pay as much as 15%. Corporate bonds is when a company issues debt, and then you go and buy the debt and you collect the interest. And a corporate bond could go up to 15%, but again, you're taking on the risk that the company defaults or company possibly goes out of business or goes bankrupt. So with the higher risk comes higher reward, but also a greater chance of losing your money. And the stock market, on average, stocks average about, what do they average? 8 to 10%. So stocks are down here. There's a risk you could lose money. The stock could go down. But for taking on that increased risk, you're also going to get a higher profit. And then way up here, we get options. Options, gosh, I've seen options profit as much as 10,000%. But what's the risk? Well, the risk is you get nothing. It goes to zero. So obviously, for that increased risk, you're going to have increased reward, but also a much greater chance of losing everything. And this is what I want you guys to understand. When you are trading options, specifically, if you're just buying calls or buying puts, 80% of options will expire worthless. 80% of options expire worthless. But that's just getting a little bit of your money back. What is the chance that you actually make money with an option? You ready for this? 90% of options lose money. 90% lose money, which means when you buy a call or a put, you have a 90% chance of losing money on that option, of not having any profit. You have an 80% chance of losing all of your money and a 90% chance of losing money in general. You only have a 10% chance of making money on that option. Now, unfortunately, for a lot of beginner traders, this is all they know. All they know is you buy options, you buy calls, you buy puts. That's all they know how to do at trade options. So what I want to do today is I want to show you how to actually make money in the long run. Because yeah, you might have that one-off where you make that 300% profit or that 1,000% profit. But as you keep trading, you get 9 in a row where they all go to zero and suddenly your profits are gone. So think about this for a second. If 90% of options lose money when you buy them, that means 90% of options make money when you sell them. Think about that. When you buy an option, you're buying an option from somebody. The person that sold that option to you is willing to sell it because they know they have a 90% chance of making money. So if you can flip from buying options to selling options, you can flip from losing money 90% of the time to making money 90% of the time. And that's what I'm going to show you how to do today, is to make that change. Let me just check the comments real fast before we move on. Chris says, it's a little slow. Okay. Chris says, this week I blew my account for the third time. Chris, I'm very sorry to hear that, but the good news is I'm going to help you turn that around. I'm going to show you how to not do that. And actually, let's just pause here for a second and talk about this, because this is the next thing that I wanted to go over, and that's risk management. Okay. When it comes to risk management, let me see. How do I create a new whiteboard? Is there a new button on here? There we go. Okay. Oops. Sorry, guys. This changed, and I'm not really sure how do I go home and new? Okay, that works. Cool. So here's what I want to talk about as far as this kind of stuff concerns is portfolio risk management. Because risk management is huge when it comes to options, okay? The problem with a lot of people is they look at something like Wall Street Bets, and they look at Wall Street Bets and they see how people in Wall Street Bets trade. And people on Wall Street Bets, they like to do this thing called YOLO, YOLO. YOLO means you only live once. And it's essentially where you take all of the money that you have saved up from your entire life and you throw it into a single option trade. Now, here's the thing. I already told you that 90% of options traders are going to lose money when they're just buying a call or put. And if that's all you're doing is buying calls and puts, you have a 90% chance of losing. Look what happens on Wall Street Bets when people try to attempt this strategy. And most importantly, look at what happens on Wall Street Bets when people don't have good risk management and they're putting all of their money into a single option or a large portion of their portfolio into a single option. I just want to show you the wrong way to do it, and then I'm going to show you the right way to do it. So look at this. This guy says, what are the odds of losing 7 earnings plays in a row? Well, as I just explained, pretty high, considering the fact that 9 out of 10 of your options trades are going to be losers. Well, you lose 7 in a row, kind of makes sense. That's kind of how options work. Down 50%. Okay, down $3,000. Still has, what, $11,000 in his account. This guy says he YOLO'd $50,000 house down payment 2 weeks ago. Long story short, I won't be buying the house or getting the deposit back. He's down $37,000. Guys, don't do this. Please don't do this. This is gambling at its worst. This guy seriously needs to go to Gamblers Anonymous. Don't ever invest money that you cannot afford to lose. That's number one rule of risk management. Do not invest money that you cannot afford to lose. I'm going to put that down here. That is literally rule number one. Do not invest what you cannot afford to lose. So critical. You guys understand this. So rule number one, don't invest what you cannot afford to lose. So important. Let's move on. This guy, let's see. Well, at least he admits he's a gambling addict. He's down 66%, down $14,000 this month. He's got $7,000 left. Geez, down $100,000 today. Okay, well, this is a little bit different because if you notice, this option is for 2025. This is called a leaps option. A leaps option is okay. It's literally about the only situation where it's okay to buy a single leg call or put, because these are fairly low risk. Leaps call options, the reason they're low risk is because they're so far out dated wise that you have plenty of time to make money. But obviously you got to deal with short-term ups and downs. The only reason this guy's down this much, like he put what, $200,000 into this. This guy's probably got $20 million in his account. $200,000, like 1% of his total account. That's fine. You know, you're down 1%. That happens all the time. No big deal on that one. Let's see what else we got. PayPal, he was up 27,000. Now he's down 50,000. Well, that's what happens with options. They can flip on a dime. Oh my gosh. This guy's got $3,000 left in his account. And he's down $19,000, 83%. Oh my gosh. Guys, this is what happens when you try to buy calls and puts. This happens all the time. Oh, man. This guy's down. Look, every single time. Just down, 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 down. This guy's depressed. Oh, guys. Yeah, if you guys start getting depressed, please just call a suicide hotline or something. Just don't get to this point. Please, guys. This guy's down $30,000 on Palantir. Oh, my gosh. How are you down up? How are you down on Palantir? Palantir's been going up like crazy. I mean, look at these. Just so many. Oh, another one. $300 in his account. He's down $14,000, down 97% all time. Oh my gosh. This guy's got $3 left in his account. He's down $82,000. Oh, oh, oh my gosh. Guys, please, please do not do this. Oh, okay. Look, here's what's happening. This is why people are losing this amount of money. Is they're putting way too much money into single trades. Guys, options are extremely risky. Limit your option trade to 1% of your portfolio. This is my rule. 1% max. 1% max. If you got a 90% chance of losing money, you don't want to lose more than 1% of your whole portfolio on a single trade. Okay? 1% max. And then the other thing is limit your total option trades to 10% of your portfolio. Okay? Guys, look, 90% of your portfolio should be 90% of your portfolio should be in stocks. It should be your investments, your long-term investments. Don't more than 10% of your portfolio in options, and don't do more than 1% of your portfolio in any single option. Because if you do, you're going to end up like all those guys on Wall Street Bets, losing a ton of money. Risk management is the number one most important thing you have to understand about options. Okay? And this is why people get so upset about losses. Last week, I made money. I did a gamble on a Tesla put option for earnings, made money on it. I did a gamble on a Google call option for earnings, made money on it. I did a gamble on an Amazon put option for earnings, lost money on it. Those three options combined, I had a 10% profit. But for some very interesting reason, people ignored the two gains on Tesla and Google, and they all focused on the loss on Amazon. People ignored, like I had like maybe 3 positive comments total on like Tesla and maybe 3 total on Google. And then I had like 100 negative comments on the Amazon. And I think the reason for that is because people are putting way, way too much money into a single put option, and they're losing tons of money. And obviously, I mean, one guy, he put in the comments that he lost $14,000 on the Amazon put. $14,000. Guys, clearly, if somebody is putting that kind of money into it, then that's why people are getting so upset. I mean, I would be mad about losing $14,000. You know how much money I put into that put option? $200. Now, look, $200 might be a lot of money for you. For me, it's not. Yeah, $200, I don't care. I lost it. I don't care. I put $200 into that thing. So I lose $200. I don't care, right? But obviously, if it was 14 grand, I'd be pretty upset. So this is the thing. If you practice good risk management, you're not going to get upset about losing money on one particular option. You know, you're just going to get it back. And this is the thing. You've got to have good risk management, because even if we flip, right? Even if we flip, we start selling options instead of buying them. Even if you do make money 80 to 90% of the time, you're still going to have those times where you lose 3 or 4 or 5 in a row, because just because it's 80 or 90%, it's like a coin flip, right? Coin flips 50% of the time. But even if I flip that coin 50% of the time, it might still go heads 8 or 9 times in a row. So you have to have enough risk management. You have to have your trade small enough to where you can handle multiple losses in a row until things turn around and you start getting multiple wins in a row. So before I go any further, we've talked about your emotions. We talked about risk management. We talked about what not to do. Before we get in what to do to actually make money, let me just go through these comments real fast, make sure we're not missing anything. Chris, thank you for your comment. All right, Shuri, we're going to get into your question in a minute and kind of explaining this. Jeff, I'll get into your question as well. TJ, thank you so much for the super chat. Keep it simple, sell puts, sell calls, collect premiums. Rolling is the key to success. Yes, you talked about the wheel deal. We'll talk about the wheel strategy here in a minute. Thank you so much for your super chat, TJ. Let's see. Yes, everybody, please don't forget to hit the like button and subscribe. I appreciate you guys so much. Also, click that bell icon on YouTube. How much money do you need to sell options? Okay, good question. When you trade options specifically for selling them, you're generally, if you're going to do a multi-leg option, you're going to need a margin account and $2,000. Those are going to be your minimums. You need a margin account and $2,000 in order to sell options. All right. TJ says you also need enough money for 100 shares. That's only true on cash secured puts and covered calls. We'll talk about that in a minute. There are ways to do it with significantly less money. There are options you can sell with as little as $100 or even I've sold options for $50 in my account. So we'll talk about how to do that as well. You don't need a lot of money, but you do need a margin account. All right. Let's see. Thank you so much. Not so Blue Bear for the super chat. I really appreciate it. You guys are amazing. Thank you guys so much. Let's see what we got. Yes, show us the way. Okay, let's do it. Let's show us the way. And yes, you're absolutely right. Playing earnings is gambling. Yes, it is. Please understand that. Keep those earnings plays exceptionally small because it is gambling. By the way, if you guys want to gamble, I heard Mega Millions is up to like 1.55 billion or something. $2 for a lottery ticket. Chance to get, I think, like 700 million after taxes. That's the way to gamble right there. Okay. Yeah, gambling, guys, keep those gambles ultra small. If you feel like you have gotten to the point where you are just gambling too much, if you feel like you've gotten to the point where you are putting money into options that you literally cannot afford to lose, like the guy that did his house down payment that I just showed you, if you're getting to that point, if you're putting your rent money, your mortgage money into options, guys, I want to strongly encourage you, please contact Gamblers Anonymous. Just Google Gamblers Anonymous. I think it's ga.org. Let me just check that for us real fast. I think it's ga.org. Nope, it is not. All right, hold on. Gamblers Anonymous. It's gamblersanonymous.org. Guys, if you are at the point where you are putting money into options that you just can't, gamblersanonymous.org, please go to that website and get some help. Let me just be perfectly honest with you guys. Let me turn this off because I really want you guys to get this and understand this. A lot of people, they look at me and they think, okay, well, here's this guy who, he's been investing for 25 years. He worked for Merrill Lynch. He worked for Morgan Stanley. He knows a lot. He's on YouTube. He's got his own coaching program. Like, this is a guy, he's got it all going on. I want to let you know that was not always the case, okay? About 15 years ago, I was homeless. And the reason I was homeless was 100% my fault. I was homeless because I was addicted to gambling. Now, it wasn't the stock market. It was actually poker and the casinos. But I was addicted to gambling and I lost all my money. I lost my rent money. I lost everything and I got kicked out of my apartment and I couldn't get a new one because I was addicted to gambling and I ended up becoming homeless. Look, this can happen to anybody, okay? I really, really want you guys to go out and get help before you get to that point where you're homeless, before you get to that point where your wife leaves you, before you get to that point, get help, okay? There is help, all right? There is help. There is hope. You can turn things around. There is a better life in your future. If you're trying to buy options with money you don't have, please go get help, okay? I encourage you to go to gamblersanonymous.org. They helped me out a ton, all right? I was in that program within 6 months. My life started to turn around. I was able to get a new apartment, get back on my feet. And you know what? Years later, here I am. And I'm here to help you guys out. So I really want to go through that because this hits me personally, okay? This really hits me personally because I've been there. I've gone through it. I don't want you guys to have to go through that pain. All right, guys, that's all the emotional stuff. I think we've covered everything we really need to talk about in that sense. Let's get into the actual training now, okay? And let me pull up, what screen is it? Nope, wrong screen. Hold on. There we go. That's not the screen either. Okay, now we got it. All right, guys, let us get into some of the training. So let me go ahead and move this over. Let's get a new one up, and we're going to talk about what happens with options. So think about this for a second. When you buy a stock, there are some things that stock can do. After you buy a stock, let's say you buy a stock right here, the stock can do one of 5 things. The stock can go up a lot. The stock can go up a little. The stock can trade flat. The stock can go down a little, or the stock can go down a lot. And these are the 5 things that a stock can do. So it can go up a lot. It can go up a little. It can go trade flat. It can go down a little. And it can go down a lot. Now, when you buy a call or a put, let's just say you're going to buy a call option, right? If you buy a call option, what are the odds that you're going to make money? How do you make money? Well, a call option makes money when the stock goes up a lot. So if you buy a call option, this is how you make money. Why did it do that? I don't know. I'm trying to do a rectangle shape, but it's trying to fill it in. I don't know how to do this new thing here. Very confusing. All right, we'll just use a pen. Okay. So when you, wow, what is that? Rainbows? All right. Anyway, when you buy a call option, there's only one way to make money, and that's if it goes up a lot. If it goes down, obviously you're going to lose. If it goes flat, you're going to lose. Even if the stock goes in your favor and goes up a little bit, you still lose money because of time decay and volatility and all these other things that are priced into an option. Now, so this is why, how often does a stock go up a lot? Well, pretty rarely. In fact, only about 20% of the time. Now, let's say you were to buy, I gotta get the shapes working. I'm gonna try again. I don't know how to change this, but we're gonna try again. All right. Actually, is there a setting or something? Shoot. Yeah, I don't know. I don't know. Is that something that you can do? I don't get it. Oh, there we go. Okay. So can I turn off the thingy-majiggy? Does that work? Nope. Okay, I don't know, guys. I can't figure it out. We'll just do this. Okay. Let's talk about when you sell an option. Well, when you sell an option, or sorry, when you buy a put. When you buy a put, there's only one way you make money when you buy a put, and that's if the stock goes down a lot. Obviously, if you buy a put option, these make money when the stock goes down. You're not going to make money if the stock goes up. You're not going to make money if the stock goes flat. Even if the stock does go down a little, you still lose money because of the time decay and the volatility and everything else that's priced into it. And the only way to make money with a put option is if that stock goes down a lot. And that only happens about 20% of the time. Only 10% of the time do you actually make money. So here's the problem that we kind of run into. So I want to ask you this. If somebody who buys a call option makes money if it goes up a lot, guess what? Somebody who sells a call option will make money if it goes up a little. If the stock goes flat, they'll make money if the stock goes down a little. Heck, they'll even make money if the stock goes down a lot. And here's the crazy thing. If I were to buy let's say I bought a stock. I'm just buying the stock, okay? Let's say that's all I'm doing is buying a stock. Guess what? If all I'm going to do is buy a stock, then I will make money in these two scenarios, right? I make money if the stock goes up a little. I make money if the stock goes up a lot. If the stock trades flat, I don't make any money because I'm going to have commissions and fees. If the stock goes down a little, I don't make money. If the stock goes down a lot, I don't make money. If I buy the stock, I only make money if the stock goes up a little. And if I buy a call, I only make money if the stock goes up a lot. But here's the cool thing. Here's the really cool thing. Let's say, so we know that if I buy the stock, I make money in two scenarios. If I sell a call option, I make money in all four of these scenarios. Why? Because the call option only becomes profitable for the buyer if the stock goes up a lot. So if I sell a call option, I make money if the stock goes down a lot, goes down a little. I make money if the stock trades flat. I even make money if the stock goes up a little. So if I buy a call option, I only make money in 1 out of 5 scenarios. If I buy a stock, I only make money in 2 out of 5 scenarios. But if I sell a call option, I make money in 4 out of 5 scenarios. All right. This is so cool. Let's do the put option. Same thing, right? If I short a stock, I'm going to make money in 2 scenarios. I'm going to make money if the stock goes down a little or down a lot. If the stock goes flat, I'm losing money because I got to pay interest on my short. If the stock goes up, I'm losing money because I'm shorting it. I'm making money if the stock goes down. What if I buy a call option? Well, if I buy a call option, I only make money in 1 scenario, and that's if the stock goes down a lot. What if I sell a put option? Well, if I sell a put option, now I'm making money in 4 scenarios. I make money if the stock goes up. I make money if the stock trades flat. I even make money if the stock goes down a little. So if I just buy a single put option, I'm only going to make money in 1 out of 5 scenarios. But if I sell that put option, I make money in 4 out of 5 scenarios. So let's talk a little bit more about how this, might actually work. So let's just do a little bit of fake math. And this math, again, it's fake. It's just to kind of keep things simple to kind of explain how this might work. Let's say we're dealing with a call option, right? And on the call option, we'll do the option price, all right? And then we'll talk about the stock price. And then we'll talk about the profit for the buyer of the option. That's if you buy a call option. And we'll talk about the profit for the seller of the option, the person who sold the option. Okay. Let's say that the stock price starts out at $100. And let's say you're buying a call option and, it's on XYZ stock. And let's say the option is for $105. Okay. Now, a $105 call option, if it expires at $105 or less, it expires worthless. If it expires more than $105, it makes money. Now, the $105 call option, let's say it costs $1. Okay. So you're going to buy this for $1, and this is what it is. Now, let's say the stock closes at this $105. Okay. So let me do it this way. Actually, let's do right here. And this is going to make my life easier. And we're going to do that same $1. Okay. Let's say that the stock closes at $105. Well, what is the option worth at $105? Well, it's worth 0. We just talked about that. Actually, let me make it easier to understand. Let's say it's 104. Okay. The option's worth 0. So what is the profit for the buyer? Well, it's a loss of minus $1. Why? Because he had to pay $1 to buy the option. What about for the seller? Well, the seller, it's a profit of $1 because the seller sold the option and he makes $1. Now, think about this because I don't want you guys to get confused. If you guys have any questions, please ask in the comment section. Right now, from what we got right now, does this make sense? Please, in the comment section, ask me any questions. Does this right here make sense? That if the call option expires for less than the strike price, this is the $105, the strike price. If it expires less than the strike price, then the buyer of the option loses all of it, and the seller makes one. Okay, yes, makes sense. Okay, now in this scenario, what happens? What was the outcome of this? Well, in this scenario, the stock, it went up a little, right? That's what happened here. The stock went up a little. Okay. Let's talk about what happens if the stock goes, let's say it trades flat. All right. Let's say our stock is going to trade flat. And if the stock trades flat, it means we finished at $100. All right. Well, if we finish at $100, the option's still worth 0 because it's less than 105. The buyer loses $1 and the seller gains $1. What happens if our stock goes down a little? All right. If it goes down a little, let's say it goes down to say $95. The option is worth 0. The person who bought the option is still out $1, and the person who bought or sold the option is still up $1. Let's say the stock goes down a lot. It goes down a lot. Let's say it goes down to $90. Well, the option is worth 0. The buyer still is out $1. The seller is still up $1. Okay, let's say it goes up a lot. The only case in which the buyer makes money goes up a lot. Let's say it finishes at $110. It went up a lot. Well, in this case, the option price is worth the difference between the ending price of the stock and the strike price, which is $5, because 110 minus 105 equals 5. Now, what is the profit to the buyer? What do you think? Throw it in the comment section. What is the profit to the buyer of this stock? What do you think his profit is? Let me know. Let me know. Throw it in the comments. What is the profit for the buyer? The option's worth $5. How much does the buyer profit? Well, if you said $5, you'd be wrong because remember, he had to pay $1 to buy it. So his actual profit's only $4. And what is the profit for the seller? Well, $4. So the buyer is going to, oh, yes. Actually, DPR Course is right. We'll get there in a minute. Give me a second. $4. Okay. Now, DPR Chords brings up a good point. He says 500, not quite, actually 400, but why? Well, it's because when you're buying and selling options, just the basics of buying and selling options, these are typically worth 100 shares. So any profit or loss has to be multiplied times 100. So you're right. The actual profit and loss on all these is 100, 100, 100, 100, 400. And then the actual profit and loss on these is plus 100, plus 100, plus 100, plus 100 minus 400. So yeah, it's actually because of 100 shares, it's multiplied times 100. So this would be the actual profit and loss. Now, we talked a minute ago about how often this actually occurs. Okay. How often does a stock go up a lot? Well, this actually occurs about 10% of the time. The stock going down a lot also occurs a little bit less than that, but we'll just call it 10%. The stock trading flat doesn't occur very often. We'll call that 10%. There, you got 70% left. It'll go down a little about 30% of the time, and it'll go up a little about 40% of the time. It's just because stocks generally go up over time. And so that's why you have a little bit of a better chance of that stock going up than you do of it going down. So what ends up happening is the profit and loss occurs like this. So because the profit and loss occurs like this, let me just tighten this up a little bit so I got more room to type. What ends up happening because of that is, let's talk about how often these are going to occur. So if we look at how, actually, let me move this over a little bit. Okay. So let's talk about how often this occurs. This is going to occur 40% of the time. So let's say that we were to run this exact play 10 times. If we do this exact play 10 times, what happens? Well, we do the exact play 10 times, 4 times, 40% or 4 times of 10, we're going to lose $400. So this is going to end up being an average of $400. And 10% of the time, it's going to go flat. That's going to be 100 because 1 time out of 10. All right. This is going to occur how often? 30% of the time. So it's 3 times out of 10. So it's $300. This is going to occur 10% of the time. That's 1 time out of 10. So that's $100. And this is going to occur 10% of the time. All right. That's 1 time out of 10. And this is plus $400. All right. Now, watch this. Watch this. You guys ready? Let's go look at the seller, and then we're going to total all this. Okay. So 4 times out of 10, this is going to occur 4 times or $400. 1 time out of 10, 10%. 1 time out of 10, this occurs 1 time, $100. Again, for every 10 times we do it, 3 times out of 10. All right, this is going to occur. So this is going to be $300, 3 times 10. All right, 1 time out of 10, this is going to occur. $100. And then 1 time out of 10, this is going to occur. This is going to be a loss of $400. Okay, now watch this. What's the totals? Looking on the right, what are the totals? Well, let's do some math. I'll go ahead and pull up the calculator for you guys. And let's do it. We have $400. All right, let's do our buyer of the option first. All right, he lost 400. He lost 100. He lost 300. He lost 100. He made 400. That is down $500. All right, so this totals out to be a loss of $500 if you run this 10 times in a row. Let's go over to our seller, and our seller made $400, made $100, made $300, made $100, lost $400, net profit $500. Again, if we run this 10 times in a row, this is what we end up with. And $500. So what ends up happening here is that if you just run this 1 time, What is the outcome? Well, I don't know, right? It's luck. Just doing it one time, it's pure luck. It might be a $400 profit that one time. It might be a $100 loss. You don't know. But if you run it 10 times, and especially 100, and even more so if you do it 1,000 times, the more often you do this, the more often these percentages actually come true. And as these percentages start to come true, the more often the average profit and loss starts to occur as well. Now, again, we ran this 10 times. What is our average profit and loss? Well, if we divide this by 10, this would make an average loss of $50 every time you do it. And again, we ran this 10 times. This makes an average profit of $50 every time you do it. So in this particular case, if you were to do this and you were to buy a $1 option for 5% above the current price as a call, on average, you're losing $50 every time you do that. If you were to sell a $1 option, 5% above the price, and you're going to do a call, on average, you make $50 every single time you do this. All right. Before we go any further, do you guys have any questions about why it is better to be a seller than a buyer? Let me just go through, see what we got. Just to answer your question real fast, this is being recorded. It will be available on YouTube for all time. Any questions, guys? All right, while I wait to see if we have any questions, I did want to let you know that if you guys want more training like this, I do have a coaching program where I go through everything and I can just help you guys out with whatever you need. If you are enjoying this training, you want more like this, definitely check out the coaching program. It's at weprofitdayandnight.com. We do this kind of training all day long. We answer your questions all day long. We have tons of lessons that are on there that you can go through and watch on your own time. And then in addition to those lessons that you can go through and watch at your own time, we also have coaches that will answer your questions all day long. There is live trading available to you if you want to do one of the masterminds. There are trade alerts about what I'm doing, what I'm buying, what I'm selling, and as well as what the coaches are doing and buying. And it's just an incredible help. So if you want more training like this, definitely go check out that coaching program. Okay, let's get back into it. I don't really see any questions coming up. So let's just continue the this. So again, it doesn't matter if it's a call or a put, it all works the same way. On average, when you buy an option, you're going to lose money. And when you sell an option, you're going to make money. Another question here. Question is the coaching program a one-time fee? It can be, yeah. You have your choice. You can do monthly or you can do one time. It's entirely up to you. Okay, back to the training over here. Let's move this out of the way and let's start talking about how to actually do this, because I think we get it. We need to be selling options, not buying up. The question now is how? How do we actually do this? So, how to sell options. All right. There are there's 4 ways or a couple different ways to sell options. There's some good ones and some bad ones. One way to sell options is with something called a covered call. Another way to sell options is something called a cash secured put. Another way to sell options is by selling what's called a naked option, which is where you're literally just selling a call or put. And the other way to sell it is with multi-leg options. Now, of these, there are some good ones and there are some bad ones. If you're doing a covered call, a covered call is when you own at least 100 shares of a stock and you're going to sell a call option, and you're covered because if the call option ends up being exercised, then you're covered with the shares that you currently own. A cash secured put is the same, but just the other way around. You sell a put, but that put is secured by some cash on hand. So if it ends up being exercised, you have the cash to actually buy the shares. Selling naked options is when you don't have any shares, you don't have any cash, you're just going to sell the option. And that is exceptionally dangerous because, as we explained, if you sell an option and it goes against you, your loss is unlimited. Okay. If it's just a naked sell, your loss is unlimited. We did $110. What would have happened if it hadn't gone to 110? What would have happened if it had gone to, say, 200? Just as an example, how much would that option have been worth? The answer is $95. If it had gone to 95, we're not talking about $400 here. We're talking about $9,500. For the seller also means a $9,500 loss. Can you imagine trying to make $100 and ending up with a $9,500 loss? There are literally huge investment companies, huge banks and firms that have gone out of business because they were selling naked options. Don't do this. You don't really have to worry about it. Most people don't even have the ability to do this. Generally speaking, your broker won't even allow you to do it. Okay. By the way, we're going to have to backtrack a little bit because I think I'm getting a little bit ahead of myself. This actually isn't going to make sense for a beginner. So let me explain a little bit of beginner stuff real fast. What is an option? Probably should have covered this first. A little bit more beginner. What is an option? This is important because I think a lot of people don't even know the answer to this question. An option is the option to buy or sell a stock at a set price by a set date in the future. Okay? Here's why this is important to understand. All right? You have to understand this. Let's talk about a call option. All right? Now, what is the question here? Got a couple of questions we got to answer. One is buy or sell. What is the set price? And what is the set date? Let's answer these questions, okay? Let's go back over to text. A buy or sell. This is the difference between a call or put, okay? Call equals buy, sell equals put. Oops, did that wrong. Put equals sell. Okay. Set price. What is that? Set price is the strike price of the option, and the set date is the expiration date of the option. All right. The way a contract will be written is it's going to be this. It's going to be the ticker, the expiration date, the shares, and the price. All right. The way this is going to look is it's going to look something like this. AAPL 14 Jan 24 100. Oh, whoops. Forgot the strike price. It's actually going to be strike price shares price. Okay, so this is going to be the strike price. Call it 200. And then it's going to be, wait, nope, I did that wrong. It's actually going to be over here, 200, 100, and call it $15. I don't know. I'm just making this up. All right. It's actually the shares come before the strike price generally. Okay. here's what all of this means, okay? Is and here's what all this means. The ticker, that's the stock, what's known as the underlying instrument or the underlying security, the stock. So in this case, it's Apple, right? AAPL, Apple. The expiration date. The expiration date is written as the day, the month, the year. Day, month, year. So on the 14th of January, 2024, this option's going to expire. What did I had it right. What am I doing? Okay, sorry guys. All right. Next is the strike price. This is the price that the option would actually have to get to. Remember when we showed you this over here, $105 call option, and it only made money if the stock went up a lot, like above $105. That's what the strike price is. So this means that it only makes money for $200. Oh gosh. One other thing, obviously, if whether it's a call or a put, it's pretty important to know. That will also show up on this as well. So this will generally show like this. Okay. So in this particular case, oh my gosh. All right. Sorry, guys. We'll get it. Bear with me. Definitely not perfect at typing here. Okay. So the strike price, $200. That's how much it has to get to. The call or the put, call, meaning it has to get above $200 to make money. 100, this is worth 100 shares. So just know that if it gets to 205 or $5 in the money, it's worth $500. Just basically multiply times 100, and then the price, $15. Okay. So check this out. What all of this is, and generally, if you see this would be like an at, right? Meaning you're buying it at $15. So if we see something like this, what does this mean? Okay. Well, this means that this is an option. The option gives you the buyer. This is very important. You have to understand it gives the buyer the option. Okay. An option gives the buyer an option to buy or sell a stock at a set price, set date, blah, blah, blah. Let's go fix all this. A buy or sell at a set price by a set date. Okay. So what is this? This means that this option gives the buyer of the option the option to buy or sell. Well, it's a call, so it gives the right to buy. What stock? AAPL. At what set price? $200. What set date? 14th of January, 2024. Okay. So what does this mean? This means that on or before, this is so important to understand. Some people don't understand early expiration. Here's what this means. On or before the 14th of January, 2024, on or before the 14th of January, 2024, the buyer of the option has the option, but not the obligation, meaning they can do it if they want to. They're not forced to. They have the option, but not the obligation to buy. Why buy? Because it's a call option. To buy 100 shares. Why 100 shares? Because this is worth 100 shares. To buy 100 shares of AAPL. Why? Because it's an AAPL option. On or before the 14th of January, 2024, the buyer of the option is the option, but not the obligation to buy 100 shares of Apple at $200, which is the strike price. Okay. That's basically what this means. So if you see AAPL 14 Jan 2024, $200 call, 100 at 15, that's what all this means. This contract means that on or before the 14th of January, 2024, the buyer of this option has the option, but not the obligation, to buy 100 shares of AAPL at $200. Okay, here's why this is so important to understand, okay? Is because let's talk about what's going to happen on or before the 14th of January, 2024. If Apple is below $200, would the buyer of the option exercise this right to buy the shares? No. Here's why. Why would I exercise the right to buy Apple at $200 per share if I can go on the open market and buy Apple at $190 a share? Doesn't make any sense. So I'm not going to exercise my option to buy the shares. If Apple is at $190, I'm just going to go ahead and let this option expire worthless. I'm not going to exercise it. It makes no sense. Let's say Apple is trading at $205 per share at expiration. Am I going to exercise the contract? Yes. Why? Because if I exercise the contract, I can buy Apple shares at $200 per share. But if I go in the open market, I am going to have to pay $205 per share to exercise the contract. I don't want to do that. So I'm going to go ahead and exercise the contract. Now, you might be asking yourself, well, what if I don't want the shares? That's fine. I'm still going to exercise the contract. And this is known as options arbitrage. The reason I'm going to exercise the contract is I'm going to go ahead and buy these shares for $200, and then I'm going to turn around and immediately sell those shares for $205, making $5 per share profit. So, understanding this is very important to understanding covered calls. Before we move on, are there any questions on this? Any questions at all? All right, let me answer, while you guys thinking of any questions, let me answer some questions you might have. One question you might have is, well, what happens to the seller of this option? We talked about what happens to the buyer. What happens to the seller? Well, if Apple ends at $190 per share, seller, whatever, and it expires worthless, the buyer's not going to exercise this, so the seller doesn't really have to do anything. But let's say Apple expires at $205 per share and the buyer decides to go ahead and exercise this. What ends up happening is the buyer of this option will go to the seller and the buyer will say, hey, seller, I want your 100 shares. I bought the option to buy my shares at $200. I want to buy your shares for $200. And at this point, the seller of this option is forced to give the buyer of these 100 shares, and the contract owner is going to give the seller $200 per share. Okay. So in that particular case, the seller gives 100 shares to the buyer and the buyer gives $200 to the seller. It does not matter what the price of Apple stock is at the time of expiration. If this gets exercised, the seller gets $200 per share, period. It doesn't matter if these Apple shares are worth $215 per share on the open market. It doesn't matter. The seller still only gets $200 per share because that's what the contract was for. That's the strike price of the contract, $200, period. Okay. Now, let's say here's the question. Where do these shares come from? Well, obviously the seller of this contract has to have those shares available to give to the buyer. And guess what? That's why we call it a covered call. Because before the seller can sell this, they have to own the shares. They have to own the 100 shares before they can sell the option contract. So in order to sell the call, they have to own the shares. That's why the call is covered by the owned shares. Let's do the exact same thing, but let's do it as a put instead of a call. All right. Let's say we're going to do a put instead of a call. Let's go ahead and pop this. Leave that there for a second. All right. Give me a second. Come here. All right. Let's do the put instead of a call. Let's say this was a put, not a call. All right. And let's bring it down because I know Apple's not trading that high. Let's bring it down to $150. What would this actually do? Well, the only thing that changed is the put. So now, essentially, if we look at what's happening up here, if it's a put option, then on or before the 14th of January, 2024, the buyer of the option is the option, but not the obligation to, what is it? Sell. Get out of it. I can't type with that there. To sell 100 shares of Apple at $200. Nope, sorry, changed the strike price, didn't we? 150. Okay. So let's talk about what happens in this situation. Let's say that Apple closes at $160 per share. Would the person that owns the contract exercise the contract? No. Why? Why would the owner sell his shares for $150 when he can go on the open market and sell them for $160? He would get more money selling them on the open market. So it makes sense for the owner of this contract to just let the put option expire worthless and go sell his shares in the open market for $160. But what happens if Apple closes at $140? Would the owner of this exercise the contract? Yes. Why? Because if the owner of the contract wants to go sell his shares and he goes and sells them on the open market, he would only get $140 per share. But if the owner of the contract sells this to the put buyer or put seller, meaning he's going to exercise the contract, now instead of making $140 per share on the open market, now he can make $150 per share by selling to the person that sold him this contract. So what would that look like? Well, the person that has this 100 shares and owns the contract, they would choose the option to go ahead and sell their shares of Apple at $150 instead of the market price of $140. And what they would do is they would go contact the seller of this option and they say, hey, seller, I want to sell you my shares, my 100 shares. Seller, I need you to give me $150 per share. The seller gives the buyer of the contract $150 per share, and the buyer of the contract gives the seller 100 shares. Okay? Now, what happens if, where does this $150 per share come from? Well, the seller of the put option obviously needs $150 per share in his account in order to buy the shares in the event that this option gets exercised. So what does the broker do? The broker says, okay, the broker says you're going to need $150 per share. The contract is worth 100 shares. So you're going to need $15,000 in your account before I'm going to allow you to sell this put option. That way, if the buyer of this put decides to exercise it, you will have $15,000 available to go ahead and give the buyer of this put option. And what your broker is going to do is they're going to take this $15,000 and they are going to put it into, they're going to hold on to it as security, just in case the buyer ever decides to exercise your put option. That is why this $15,000 is known as cash security. And that is why when you sell a put, it is known as a cash secured put. Any question on those first two? Let me go through the comments, take a look, see if we have any questions. No, Loud, it looks like maybe you came in a little bit late in this, so I would just recommend go ahead and take a look at the prior training that we did a little bit earlier. We've been doing training for about an hour now. So if you guys came in late, this is going to be recorded. It is going to be on YouTube. All you got to do is go back and rewatch the training. Gamma Squeeze, no, I'm not going to get into the Greeks on this training. This is very basic. Okay, so question, the contract would cost $1,500 initially. Yeah, you're talking about the $15 contract here. So would it cost $1,500 initially out of your pocket or $200? It would cost $1,500. It would cost $1,500 out of your contract initially, because if you buy this contract for $15, 15 times 100 shares is $1,500. You're gonna have to pay the $1,500 for the you're paying $1,500 for the rights to buy or sell your shares. Okay. So yeah, you got to pay for the right to do that. Okay. It doesn't look like anybody has any questions. Before we get into multi-leg options, let's talk about the simpler covered calls and cash secured puts. Okay. By the way, if you guys are really enjoying this training, if you guys want more of this kind of training, then I encourage you guys to come and check out the coaching program that we have. This coaching program, by the way, we go through this kind of training in the coaching program. We talk about fundamental analysis, technical analysis, how to read charts, how to draw trend lines, how to do Bollinger Bands, how to look at all the different technicals. We talk about all the different options. We talk about all these multi-leg options, including some of the more complicated multi-leg options, as well as emotionals and money management. We talk about day trading, swing trading, long-term investing. It's all available. If you guys are enjoying this training that we're doing today, you can certainly get more training with the coaching program. Just go to weprofitdayandnight.com and schedule a call with my onboarding specialist. Now, I will tell you that the calls are getting filled up really fast because there's just a lot of people that have been wanting to join the program. And so I don't think there's a lot of calls available. Yeah, there's only 3 days where the calls left. Everything else is filled. So if you guys want to get into the program, make sure you go schedule a call. My onboarding specialist can give you a lot more information on this program. He can just answer all your questions, but there are only 3 days where the calls left. So if you think you might be interested in that, make sure to schedule a call with the onboarding specialist now so that you can get into the program before all those slots are filled. Okay, let's get back into the training here. And let's start with our simple cash secured puts and covered calls. Okay, let's start with covered calls first. By the way, when you guys want to do this, you guys are going to have to get approved to trade options with your broker. And you might want to know what your options trading approval level needs to be. If you want to do a covered call, this is generally considered level 1. If you want to do a cash secured put, this is considered level generally considered level 2. Oops. And if you want to do a if you want to do naked options, this is considered a level 4. Most brokers will not allow you to do level 4. They like Webull doesn't even have it as an option. But if you want to do multi-leg options, you can do that with level 3. So just depending upon what you want to do and how you want to trade, these are the option approval levels you're going to need with your broker. Level 1 for covered calls, level 2 for cash secured puts, and level 3 for multi-leg options. Okay, let us continue onward here. Let's talk about level 1, covered calls, the easiest one to get approved with from your broker. Okay, a covered call. Let's talk about what it is, how it works. It's very simple. A covered call, you must make this a little bigger for you guys. Okay. So on a covered call, you must own 100 shares for every call that you want to sell. All right. It's really that simple. You own 100 shares for every call you want to sell. For every 100 shares you have, you can sell one call. And the way it works is this. When you are doing a covered call, your goal, what you want to have happen is you want the stock to end below the strike price at expiration. Okay, that's your goal. So let's say you're gonna do a stock. We'll call it XYZ stock, and XYZ stock is currently trading at $100. All right, and let's say that you owned. It's currently worth $100, and let's say you own 300 shares of XYZ stock. Okay, and you want to make money beyond just kind of holding this. So you decide that you are going to sell three call options. Why can you sell three? Because you own 300 shares. You need 100 shares for every call option you want to sell. So if you own 300 shares, you can sell three call options. You decide you want to sell three call options. And the question you always have to ask yourself if you're going to sell a covered call is, what price would I be willing to sell my shares at, and I would be happy with a profit? There's a couple of ways you can look at this. You could sell your shares for, let's say it's $120, right? And you say, you know what? I would be happy selling my shares for $120 because that would be a $20 profit or 20% profit per share. I'd be very happy selling my shares at $120. The next thing that you have to ask is when? Well, would you be happy selling your shares for $120 10 years from now? No, 20% profit in 10 years is horrible. Maybe I'd be happy with a 20% profit in the next, 6 months. So maybe you do a January, I'm just making up a date here, 14 January 24 option, right? 6 months out, January 2024. And this is what you decided to do. So what's your premium going to be on that? I don't know. Let's say it's pretty far out. Then again, $120 is pretty far above the current price. Let's say you make $5 each. So let's say the contracts are $5 a piece. What that would be, it's 100 shares. So it's $500 per contract, but you're doing 3 of them. So it's going to be $1,500. Okay. So essentially what happens is you say, I'm going to be happy selling at $120 or 20% profit 6 months from now. So you decide to sell 3 call options at $5 a piece. That's $500 per contract. 3 of them is $1,500 in your pocket. Now, if you get lucky, and let's say that XYZ stock closes on 14th of January 2024 comes along, and XYZ stock is at $110. What's going to happen? Well, the option is going to be worthless because the person that bought this is not going to buy the shares from you at 120 when he can go in the open market and buy them for 110. So the option is worthless, which means what happens to you? Not only do you make $10 per share just because you held the shares and the share price went up, but you also get to keep the entire $5 per share premium, right? You sold it for $5. So now check this out. The $5 per contract. So here's what's really cool about a covered call. If you had only held the shares, that's all you've done is hold the shares, you'd be up $10 per share. But by selling the covered call, not only have you made your $10 per share from the price going up from 100 to 110, you've also made $5 per share by selling the contract. So somebody who's just bought the shares has made $10 per share, but you smart sucker, you made $15 per share. So the person that just bought the shares is up 10%, but you are up 15%. Yeah, pretty smart. So this is why covered calls can actually increase your profits. And this is so powerful that the person who just buys stock will make what, an average of 10% per year. That's how much the stock market goes up per year, 10%. The person that adds covered calls to their strategy, they make an average of 30%. Well, not quite. I take it back. You also have to add cash secured puts as well. But the person that does cash secured puts and covered calls, they make an average of 30% per year. This is why this is so powerful. So before I move on to the cash secured, wait, one more thing before we move on to cash secured puts. What happens if it goes down? Probably pretty important to answer. This comes along and the stock's at $125 per share. Just say. Well, what you end up having to do is you're going to make your, well, actually, you don't make $25 per share. Why? Well, the contract's going to end up getting exercised at $120 because the buyer of this contract wants to buy your shares for $120 and then sell them on the open market for $125. So you got to sell your shares to the contract buyer for $120, which means you're going to make a profit of $20 per share. Okay. That's the $120 minus the $100. $20 per share is what your profit is going to be. But guess what? You also get to keep that $5 premium per contract. So at the end of the day, you're still getting the $25 per share. Pretty cool, right? The only time this really doesn't work out is, let's say it goes above $125 per share at expiration, then you don't get the full amount that you would normally make. Just as an example here, let's say 14 January comes along and it's $130 per share. Guess what? You make $20 per share, plus you keep the $5 per contract. The total you make per share is $25 per share. But if you had not actually sold these call options and you just held your stock, you'd be making $30 per share. So, I mean, yeah, it really has to go up a lot for this not to work out. But in any case, with this call option, did you lose money? No. Because even if it goes to $130 per share, you didn't lose any money at all. In fact, you've still made $25 per share, which is incredible. Now, what could go wrong? Is there any possible way to lose money with these? Yes, there is. And let me show you what that is. Because look, there's no free money in the stock market. There's always going to be risks. So let's talk about one way you can lose money. And that's if this sucker goes down. So at the time of the contract, it's worth $100. Let's say it goes down to $90. All right. Well, if it's $90 and your stock costs you $100, you now have a loss of $10 per share, right? Because we went from 100 to 90. The good news is you still get to keep the $5 per contract. So your total loss is $5 per share. So by doing this, you could lose money if that stock goes down in price. But the nice thing is it actually lowers your losses because you still get to keep the $5 per contract. So somebody who had just held the stock, they'd be down $10 per share. But by selling this covered call, you're only down $5 per share. So covered calls are incredibly profitable. They're an excellent way to make money with options. And that's why most brokers will allow just about anybody to sell covered calls. All right, any questions on covered calls before we move on? Let me just take a look at what we got going on here. Just go through these. All right, looks like somebody answered that. Question, is the only way to sell a call or put first buy an option contract? Yeah, the only way to sell a call is to buy the stock first. All right, generally speaking, you got to buy the stock if you want to sell a call. And we'll get to that. Well, there's one exception, that's with multi-leg options, but for now, this. Here's a question. If you have cash for 100 shares at the strike price you choose, you can sell cash secured puts to make a premium until you get assigned the 100 shares, and you can sell covered call. Yeah, that's the will strategy. We're going to go over that in a minute. Is it better to sell covered calls in a bull market? Yes. In a bear market, you don't want to be locked into your stock position. You want to be able to sell out so you don't lose too much money. So definitely you want to be doing this in a bull market. The good news is the stock market is almost always in a bull market. I mean, there are some exceptions like 2022, but with the stock market usually being in a bull market, usually this will work. Obviously, in a bear market, you do not want to do this because you will lose money. But in a bull market, it's definitely a way of increasing your profits. Okay. Let's move on. Level 2, cash secured put. How does a cash secured put work? Very simple. Very simple. All right. Cash secured puts. Here's how they work. You'll need a level 2 options training to do this, but it's pretty simple. All you got to do on a cash secured put is you must have cash in your account to buy 100 shares of the stock at the strike price. All right, that's the requirement to do a cash secured put. And assuming that you do have the cash, here's how this would work. Let's say you want to sell a put on XYZ stock at $100 strike price, and this put is going to be worth $5 per contract. Let's say that XYZ is currently trading at $105 when this actually occurs. Actually, let's do it 110. Say it's trading at $110 when this occurs. All right, here's what happens. In order to actually sell this put, your broker is going to say, all right, buddy, you want to sell this. I'm going to need $100 for 100 shares. So I'm going to need $10,000 from you. And we're going to just put this cash into security. All right, we're just going to hold on to it for you. So if I want to do this, and by the way, this is 100 shares, so it's really going to be $500. If I want to sell this put and I want to collect $500, I'm going to have to give my broker $10,000. Now, why would I do that? Why would I give my broker $10,000 to hold on to just to make $500? Here's why, and here's why this is so beautiful, and here's why you do want to do this. Let's say I want to buy XYZ stock. All right, that's my goal. I want to buy XYZ stock, but you know what? I don't want to pay $110 for it. I want to pay $100 for it. I mean, wouldn't you want to buy it for less? Absolutely. So check this out. So let's say that at expiration, XYZ stock is trading at, well, let's do the easy one first. Let's say it's at, I don't know, 105, 120, it doesn't matter. It's above $100. If that's the particular case, just nothing happens. So it's obviously not going to get exercised, right? So what ends up happening on this is you're going to keep the $5 per contract, which is $500, and you're going to get your $10,000 back from your broker. So assuming that the stock goes down a little or it goes up, so long as the stock doesn't go down to $100 per share, you're going to keep your $5 per contract. You're going to get your $10,000 back, and you're going to end up with a 5% profit. All right. 5% profit isn't great, but what if you did that every single month? Right? 5 times 12, what is that? A 60% profit in a year? Nice, right? Nice. I got the wrong camera on. Hold on, guys. All right. So yeah, so 60% profit in a year just by doing this every single month. So yeah, that's why you might want to do that. Pretty good. Okay, let's do the other scenario. Let's say it goes down. Let's say it goes down to 90. What happens? Well, if it goes down to, actually, we'll do 90 and then we'll do the 100. If it goes down to 90, you're going to keep the $5 per contract, $500. But you have to buy the shares for $100 per share because that's what you agreed to in the contract. So you got to buy the shares for $10,000. And once you do that, you now have 100 shares. But your cost, what was your cost on these 100 shares? Your cost on these 100 shares is not $100 per share because you collected $5, did you not? So your actual cost on these shares, not 100, your cost on the shares is 95. Okay. So, because you paid 10,000 for the shares, but you collected $500, so your actual cost is 95. Okay, check this out. There's the stock is worth $90. So right now you're sitting on a loss of $5 per share. Okay, or $500. In this particular case, you were sitting on a profit of 5% or a profit of $500. Now, what are the odds that this is going to go from 110 to 90? Well, 10%. So 9 out of 10 times you're going to make $500. 1 out of 10 times you might lose a little. Now, what happens if XYZ goes down to $100? Well, you still get to keep the $5 per contract, and which is $500. You now have to buy the shares for $100, which is the $10,000 that you gave your broker to hold on to. You're now going to own 100 shares. What is your cost on these 100 shares going to be? Well, you paid 10,000 for them. It's still going to be 95, right? So what are you sitting at? You're sitting at a profit, $5 per share, or $500. Why? Because the shares are worth $100. So when you do this, if it's trading 110, in the event you actually have to buy these shares, you're basically going to buy them at $95 a share. And it doesn't really matter what the share price is. You're going to buy them for $95 per share unless it stops at $100 or higher. Then you just collect your $500 premium. So why would you want to do this? Well, you would want to do this if you really wanted to own the shares, but you wanted to get them at a discount. And by the way, there's a little trick to this. Let's say I really, really want to own the shares. And this is just a side note, okay? Let's say I really, really, really want to own the shares. And I don't want to wait for the stock to come down before I own the shares. Well, let's say XYZ is trading at $110. You might decide to buy or sell a put at a $150 strike. Now, why in the world would you do this? Well, here's why. You're going to get $5 just for some time value. But guess what? You're also going to get the intrinsic value. What is intrinsic value? Well, intrinsic value is the actual value of this thing. Okay. So let's say that it's 150 minus 110 is 40. There's your $40 plus the $5 for volatility and time. The contract's going to trade for about 45 bucks. You're going to collect about $4,500 in premium, but you now have to give $150 per contract to your broker. So you're going to have to give your broker $15,000 cash into security. Why would you do this? Well, here's why. Let's say XYZ went up to $120. Guess what? You're going to keep your $4,500 per contract. You're going to now you got to buy the shares though, right? So you got to buy the shares for 150 bucks, $15,000. What's the net? You're paid 15,000, you keep 4,500. Your net is 10,500. But what does that mean? That means that you own these 100 shares cost of wait, I didn't do that right, did I? Yeah, I did. All right, so it went up. You own the shares at a cost of $105 per share. If you had just bought the shares for 110 and they went up to 120, you'd be up 10%. But because you bought the shares for 105 by selling this insanely high priced put option, you're up $15, right? So you have a profit of $15. So this is why you might want to sell a cash secured put deep in the money. But deep in the money puts are effective because it essentially allows you to buy the shares at a discount, right? If I just bought them, I would have paid $110 per share. But by selling a cash secured put deep in the money, I'm only paying $105 per share. All right. Any questions on cash secured puts before we move on? I don't see any. So let us continue with one more thing, and that is called a wheel strategy. And the wheel strategy averages about 30% profit per year. All right. How does the wheel strategy work? Very, very, very simple. All you do is you sell cash secured puts over and over until you own the shares. And then once you own the shares, you sell covered calls over and over until the shares sell. Why is that? Well, generally to get right, you might sell that cash secured put 10 times before it actually gets exercised. So by the time that you've actually bought those shares with the cash secured put, you are paying way below the market price for those shares. Then you turn around and you sell covered calls over and over and over again. And now you're just making money until they actually sell. So what ends up happening is not only do you make the profit from the stock going up, but you also make all those premiums from all those cash secured puts you sold, and you make all those premiums from all those covered calls you sold. So even though the stock market on average goes up by 10% per year, okay, let's say the stock you do this on, stock goes up 10% per year. Again, these are averages. The stock goes up 10% per year. If you just buy the stock, you're making 10% per year. But if you use the wheel strategy, you're making 30% per year. This is an incredible way to use options to make money. All right. Any questions before we move on to multi-leg options? Okay. I don't see any questions at all. Guys, are you enjoying this? Do you guys feel like this is getting too long? Somebody said it's a long live stream. Do you guys want to end this? Let me know. Is this too long? Do you want to end it and do more training later? Or do you guys want me to keep going? Let me know in the comments. Do you guys want me to end it or keep going? Just let me know. By the way, if you guys want more training like this, we have an incredible coaching program. If you think you might be interested in the coaching program, schedule a call with the onboarding specialist. He can answer all of your questions for you. And like I said, there's only a few slots left. If you don't get it now, you'll have to wait till next month. Keep going. Okay, I've got some people saying, please keep going, keep going. Okay, we'll keep going. We'll carry on. Okay, let's get into level 3, multi-leg options. And I'm only going to cover the simplest 2, multi-leg options. You all ready for this? Sorry. All right, multi-leg options. Okay, how do multi-leg options work? Well, very simple. Let's say that I want to sell a cash secured put. Let's say I want to sell a put, but I don't own the stock and I don't want to buy the stock either. Let's say I want to sell a covered call, but I don't own the stock and I don't want to buy the stock. How can I actually do this without owning it? Well, this is where multi-leg options come in. And the way a multi-leg option works is basically you sell the call. Sell the call. All right. But remember, you can't just sell a naked call without level 4 options trading. And most brokers won't allow you to do that. So when you sell the call, you're also at the exact same time going to buy a call. Or in the case of a put, you sell the put in the exact same time you buy a put. So why would we do this? Well, there's a really good reason for it. And here's why. A quick question came up on dividend stocks. No, look, if you buying calls, puts, whatever, the dividends, generally speaking, don't affect you. You don't own the shares, so you don't get the dividend. That's simple, right? Now, obviously, if you own the shares and you sold a covered call, yeah, you get to keep your dividends. But if you own the options, you don't. All right, let's do this. So how would this work and why would you do it? Well, here's why. Let's start with the call. Let's talk about the call side first. On a call, I want to sell the call. Okay, that's what I want to do. I want to sell this call, but I don't own the shares. So what would happen if I sold the call? I didn't own the shares, and the call expired worthless. No big deal. I just keep my premium. But there's a huge amount of risk if the call expires in the money. What would happen? Well, let's say, just as an example, that I sold a call at $100 per share. And let's say the stock expired at $150 per share. And I did not own the shares ahead of time. What would end up happening is the buyer of the option would say, I don't want to buy the shares at 150. I want to buy them from you at 100. So the buyer of the option would come to me and he would say, hey, buddy, I want to buy your shares for $100. So I don't own the shares. So what do? I'm going to have to go out to the open market. I'm going to have to buy the shares at $150 and sell them to this guy for $100. I'm going to take a $50 per share loss. And I might not have enough cash in my account to cover a $50 per share loss. So how can I do this if I don't own the shares? Well, very simply, I can buy a call. Now, what am I willing to buy those shares for? Well, yeah, maybe I'm willing to buy it for 105. Now what happens? Now, this XYZ stock ends at $150. Okay. And the person who bought my call option at $100, this person comes to me and he says, "Hey, buddy, I want to buy." This is the buyer of the call, okay? The buyer of the call says, "I want to exercise my contract. I want to buy your shares for $100." And what I'm going to have to do is I got to come up with these shares because I don't own them. So what I do is I say, "All right, no problem. Just give me 1 second here. I'll get your shares to you." And what I'm going to do is I'm going to exercise my call option, and I'm going to buy the shares for $105. Now, it doesn't matter that XYZ stock is trading at $150 because I have an option to buy shares for $105. So what I'm going to do is I'm going to exercise my call option. I'm going to go buy the shares for $105. I'm going to go give the buyer of my call option, the one I sold, the shares for $100. And the way all this is going to work is this. Let's say that I bought this call out, or let's say I sold this call option. I sold it for call it $5. And let's say I bought my call option for $3. What happened when I did this? So when I did this, I collected a $5 for each. I collected $5 for each share, basically, and then I took 3 of those and I spent them on a call option. So net here, the $5 I collected minus the $3 that I spent is $2 in premium that I collected, right? This is the $2 what's known as a credit. Credit because it's money coming to me. So when this expires and it's in the money, I'm going to go buy the shares for $105. I'm going to sell them for $100. I'm going to have a loss of $5 per share. Okay. I have a loss of $5 per share. But I collected a $2 credit when I bought and sold my options. So my net loss is $3 per share. Net, right? Now, check this out. Check this out. What happens if the stock doesn't go on this major rally? Because we know that the stock going up a lot is going to happen pretty rarely. Let's say, for example, that it doesn't go to 150. Let's say that this stock went to, say this stock closes at, let's call it $95. Let's say the stock closes at $95. Is the buyer of my call option going to buy the shares from me for $100 if they can buy them on the open market at $95? No. In that particular case, this expires worthless. Am I going to go buy shares on the open market for $105 if they're trading for $95? Or am I going to buy the shares for $105 if I can buy them on the open market for $95? No. So mine expires worthless. So with both of these then going to zero and expiring worthless, guess what? I just get to keep my $2 credit, which means I just get to keep my $200 profit. All right. In this particular case, I had a $300 loss. In this particular case, I get a $200 profit. Well, check this out. What if the stock was $200 per share, or $300 or $400 or $500 per share? Guess what? I still have a $300 loss. And that is why when you're doing these, this is known as a tax loss. And what if this goes down to $90 per share, or $80 or $50 per share? Are either one of these going to get exercised? No, they're both going to be worthless, which means it's going to be a $200 profit, known as a max profit. here's the kicker. Obviously, what happened to the guy who just bought this call option and he got super duper insanely lucky? Well, he ends up making a $50 per share profit minus the $5 he paid. He makes $45 per share profit. Just super duper lucky guy. He made $45 on a $5 bet. But did I lose $45 per share? Nope. I only lost $3. I only lost $3 per share. That's it. That's all I lost. So check this out. My risk has been significantly lowered, and by lowering my risk, I'm also lowering my max profit. Right? We talked about that earlier. Is or I don't know where it is. One of those over there, where when your profits go down, when your profit potential goes down, your risk goes down. Okay. I know this might be a little bit confusing, but just remember, a multi-leg option, all you're doing is you're buying and selling. That's it. That's all you're doing. And what this does is it allows you to do a cash secured put without owning the shares. So when you're doing a cash secured put without owning the shares, this is known as a credit call spread. Credit call spread is a covered call out owning the shares. And the reason that I am allowed to do a covered call without owning the shares is because I have a call that allows me to buy those shares if this trade goes against me. And the reason it's called a credit is because I received a $2 credit because I received 5 and I paid 3, which means I got a $2 credit. And the reason it's called a call is because I did this with call options. I bought and sold a call. And the reason it's called a spread is because there's a $5 spread between the option that I sold and the option that I bought. All right. This gets a little bit confusing, especially if this is the first time you've seen this. But let me kind of walk you through why this is so good. All right. And what I'm going to do now is I'm going to pull up Webull to hopefully kind of explain this a little bit better. And we'll just use the cues. It really doesn't matter what we're using, but we'll just go ahead and use the cues. All right, let me go over to options. And by the way, something I love about Webull is that they make it so easy. You don't have to set this up individually. All you have to do on your option screen, you can do this both on the app and mobile app as well, is just click up here, go down to vertical, because this is called vertical spreads. And when you do that, you're going to get all your vertical spreads. Now, we're talking about calls. Let's go out about a month out. Let's go to August 18th. Let's do out of the money because we want a credit. And this is just what it looks like. Don't worry about that. What I want to do is pull up the graph. All right. I want you guys to see this graph. Let's make this bigger. Whoop. Whoa, there we go. Let's make a graph bigger, 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 bigger. All right. Okay. Here's the cool thing. What is QQQ? What did it close out on Friday? QQQ closed on Friday at $372. All right. 372. You guys see that up here? 372. All right. This particular credit spread is a $367 and $377 credit spread. It has an expiration date of 18th of August, 2023. It is a call. It is for 100 shares. Now, I know you guys can't really see that on the screen. That's why I'm talking you through this. In order to set this up, I am selling a $376 call. I am buying a $377 call. Again, it's really tiny on the screen. Let me set this up for you. If I were to sell this, I would get a 45-cent premium. Again, a credit, 45-cent credit. Again, multiply times 100 because it's 100 shares. I would get a $45 credit for doing this spread. Now, the spread is $1 because 377 minus 376 equals $1. It's a $1 spread. What is my maximum profit on this? My maximum profit is the credit that I collect. So my maximum profit is $45. What is my maximum loss? The maximum loss is the spread minus the credit. The spread is $1 or $100 if you're looking at 100 shares. The credit is 45 cents or $45 if you're looking at 100 shares. The difference, the maximum loss, is $1 minus 45 cents, which is 55 cents, or at 100 shares, it's 100 minus 45, which is $55. So with this, my maximum profit is $45, which is the credit. My maximum loss is $55. But here's the beautiful thing about these multi-leg options, and this is what I explained earlier, is that you have the ability to make money in 4 out of 5 ways. Now, this makes money if QQQ goes down. As you can see on this profit chart, it's profitable if QQQ goes down. It loses money if QQQ goes up. And this is kind of what I was trying to show you earlier. So if we had XYZ stock and it went up to 150, I'd have a loss. If it goes down to 95, I have a profit. That is why a credit call spread is a bearish play. On a credit call spread, you want the stock to go down because that's how you make money, right? So I want the stock to go down. That's how I make money. But check this out. This is where it gets really cool, really exciting. QQQ is at $372. What happens if QQQ goes down to $370? Well, guess what? I make money. I'm like way over here on this chart. What happens if QQQ goes down to $300? Well, guess what? I make money. I'm way over here on this chart. How much money? $45. If QQQ goes down to 370, I make 45. If it goes down to 360, I make 45. If it goes down to 300, I make 45, right? I've limited my maximum profit, but by limiting my maximum profit, I have also decreased my risk. How did I decrease my risk? Well, if I just straight up buy a put, I need QQQ to go down a lot in order to make money. All right, let me go ahead and show you that real fast. Let me switch this back over to single and let me show you a put. All right, here's a put. Let's say I were to buy this put, right? Now, by buying the put, if I just bought the put straight up, I'm just going to buy the put. That's it. This is a $364 put. If I just straight up buy the put, obviously my max loss is just whatever the cost of the put is, which in this particular case is $2.68 or $268. That's my maximum loss. What is my maximum profit? Well, it's unlimited. I mean, at least until it goes down to 0, right? I mean, if QQQ goes down to $356, I make $530. If it goes down to $348, I make $1,300. I mean, you're unlimited profit on a put option, but the odds of you actually making money are very, very low. Why? Because QQQ's at $372. Look where here's $372 on this chart. And with $372 on this chart, even if QQQ goes down a little, I still lose money. Like, I would need QQQ to go, even if QQQ goes down below $364, I still lose money because I got to pay for this sucker. I don't actually make money unless QQQ goes down to $361. Wowzers, I need QQQ to drop $11 just to break even? That's horrible. But now watch what happens on the vertical. You ready for this? This is where it gets really exciting. Check it out, check it out, check it out. Watch this. Watch this profit loss graph. Watch it. You ready? Where is $372 on here? Where is it? Where is it? It's way the heck. It's not even on the screen, guys. It's way the heck down here. So guess what? If I just buy a put, I need that put. I need the underlying security to go down a lot just to break even. I would, if I bought a put option on QQQ, I need QQQ to go down by $11 just to break even. But check out the credit call spread, which is also a bearish play. If QQQ goes down 11 bucks, guess what? I make 45 bucks. If QQQ goes down $1, guess what? I make 45 bucks. If QQQ goes flat at $372, guess what? I make 45 bucks. Look at this. If QQQ goes up to 373, I make 45 bucks. If QQQ goes up to 374, I make 45 bucks. If QQQ goes up to 375, I make 45 bucks. If QQQ goes up to 376, I make 45 bucks. Isn't that cool? I make money if QQQ goes down a lot. I make money if QQQ goes down a little. I even make money if QQQ goes up a little. With a credit call spread, I make money if QQQ goes down a lot, down a little, trades flat, or even goes up a little. I still make money. The only time I'm going to lose on this is if QQQ goes up a lot. My break even on this is around $376.45. I would need QQQ to go up more than $376.45 before I even lost money. And when I do lose money, my loss is maxed out at $55. How cool is that? And then, of course, if you do the opposite, right? Well, actually, before I move on, any questions? Any questions on that on that vertical? How that would actually work? Anybody have any questions on this? Let me go through. It looks like there's been some questions in the chat here, so I just want to go through and review and just see if anybody had questions on that. I don't know where my little window went. There. All right. Let me go through. Let me see what we got. See if we got it. And by the way, when you guys do this, make sure it's set to sell. That's how you make money on these. You got to sell them. You got to get that credit. All right. You're saying you keep applying for level 3 on Webull, it only can get level 2. Yeah, you generally have to have a little bit of experience to trade options. So if you're not getting it, just let them know you've got more experience and do the training on Webull, and they'll usually approve it at that point. Yeah, the example is a $45 credit at 100. Oh no, sorry, the example is a 45-cent credit at 100 shares. Okay. So the amount of money you need in your account to actually do this is just the max, the spread's $1. So if you had $100 available to trade, you could actually do this. You still need, obviously, the options level approval. You still need the margin. You still need at least $2,000 account value. But you only need $100 in buying power in order to actually do this. Yeah, guys. Yeah, I appreciate it. Yeah, keep liking, subscribing, click the bell icon, all that stuff. Let's see what your thing is. I buy put option spreads at 5 spots over the 52-week high. Yeah, great strategy. Absolutely. Where do you find the credit call spread window in Webull? Okay, walk you through it one more time. You go to options, you change single leg to vertical up here. All right. Then you pick one that you want to sell. You click on it. Once you click on it, you get this little screen. It's your order entry screen. And then there's a button in the bottom left that says graph. You click that, and that's what allows you to see it. Okay. That looks like all the questions. Let's move on to cash secured puts. But instead of having $10,000, $15,000 cash, Let me show you guys how you can do this with a credit put spread. Really exciting. I love this stuff, guys. If you can't tell, I love these vertical spreads. I mean, they're just, the odds of making money are way, way, way higher. And your profit potential is just so much higher on these. By the way, guys, again, if you're loving this stuff, go check out the coaching program where we go into way more detail than what I'm going on in this. A ton of lessons. I have hours and hours and hours of lessons over there. Plus, you get the coaching, you get help, you get to learn how all this stuff is done. There's only a few slots left for August, so make sure you go schedule a call with the onboarding specialist now before those slots are filled up. If you don't do it now, you're going to have to wait till September. And as far as pricing and all that stuff, obviously the onboarding specialist can go through it with you. Okay, let's do the other one, which is the put. All right, on the put, very, very, very similar. What you're going to do on the put is you're going to buy a put and you're going to sell a put. That's it. That's all you're doing. Buy a put, sell a put. Now, same thing. If I don't have the cash to actually sell a cash secured put, I can still make money this way. And kind of here's how this goes. Okay. Oh, by the way, a credit put spread is bullish this time. Don't get confused. Credit put spread is bullish. So in this particular case, I want the stock to go up. That's how I'm going to make my money. All right. Let's talk about how that is, why that is. Here we go. I'm going to make sure I do the same thing. This is basically the ability to do a cash secured put without the cash. Basically what we're trying to do here, okay? All right, let's do it. We'll do the same thing, all right? I'm just going to copy and paste so we can kind of go through this. And so I'll copy and paste this. That way we get the exact same example. All right. For this, we're now doing a put. So we're going to go the opposite, though. And again, a put. Again, we're going to do the opposite. All right. So here we go. So I'm going to buy a put a little bit closer to the money. I sell the put a little bit further out. I'm sorry. Sell the put closer to the money. Buy the put a little bit further out. This is going to end up with a $2 credit. Same as last time. All right. Let's do both scenarios here. All right. And I don't know, we'll make it a little bit more generalized. All right. Get rid of this. This is for the call, and get rid of this. This was for the call. Okay. Oh wait, quick question. Good question too. Do I ever roll over spreads? No, I do not roll over spreads. I want those to expire worthless. That's the goal. You want these to expire worthless. I do not roll them over, and if I hit my max loss, I hit my max loss. It's just the risk of doing it. If anything, I'll just close it out early if it's looking like it's not going to go in my favor. Okay. All right. So we have sold a put for $105. We've bought a put for $100. We have a $2 credit. What happens if our stock goes to 110? Well, if the stock goes to 110, and what's the buyer of my put going to do? Is the buyer of my put going to want to sell his shares to me for $105 if he can go sell them on the open market for 110? No, that makes no sense. So this put is going to expire worthless. The 105 put is expiring worthless. I'm certainly not going to sell shares at 100 when I can sell them on the open market at 110. So my put's expiring worthless too. And with both expiring worthless, I'm just going to keep my $2 credit. What that means is I'm going to have a profit of $200 because, again, 2 times 100 shares. And this is going to be my max profit. Okay? Now, doesn't matter if XYZ stock goes to 110. Doesn't matter if it goes to 150. Doesn't matter if it goes to 200. I have a $200 max profit. That's it. Let's say it goes down. Let's say it goes down to $95. the person that bought the put for me, does he want to sell his shares to me for 105? Yes. Why would he sell them on the open market for 95 when he could sell them to me for 105? So obviously he wants to sell the shares to me for $105. So the buyer of the put now comes to me and he says, hey man, I want to sell my shares to you for $105. I'm like, crap, I don't have $105. How am I going to come up with $105? I say, all right, you know what? That's fine. You can go ahead and sell your shares to me for $105. No problem. I'll just give me 1 second. I'll get you that cash in just 1 second. And the buyer's like, okay. So he sells the shares to me for $105. Now I'm going to owe him. I got to owe this guy $105 per share. Where am I going to get the money? Well, I've got the ability to sell shares at $100. So what I'm going to do is I'm going to go to the person that sold me this put option. I'm going to, hey man, I want to sell shares to you for $100. So I'm going to take the shares. So this first, so now I own 100 shares, right? But at the same time, I owe 100 shares. I owe the buyer of my puts 10,000 or yeah, $10,500. So now what I'm going to do is I'm going to take these 100 shares. I'm going to sell them to the put I bought, to the seller of the put I bought. So now what I'm going to do is I am going to sell the shares for the $100. All right. Which means I'm going to collect $10,000, right? So what happens is I collect $10,000 because I sold the shares. Now I'm going to give $10,500 to the buyer of my puts. All right. And the net is I had to give away $10,500 to the buyer of my put, but I collected $10,000 by selling those shares at $100. Okay. That's a net loss of $500. All right. And that's the spread. That's the spread. The 105 minus 100 is 5. 5 times 100 is 500. That's your spread. But I also collected $200 in premium. Remember that $2 credit, $200 in credit. So my loss is $300. So I lost $5 per share. I got a $2 credit. I lost $3 per share net, right? $300 loss. So in this case, if the stock goes down, I have a $300 max loss. Okay. So by doing this, it's bullish because I want it to go up. So long as the stock goes up, I make my money. If the stock goes down, I lose money. All right. So the simple way of understanding this, let's go over to now, as far as all this buying and selling of shares, right? Like somebody said I'm making it too complicated. Let me simplify this really. As far as all the buying and selling of shares, you don't have to worry about any of this. All right. Don't worry about any of this. Why? Because your broker is going to take care of all that for you. You don't have to worry about it. Your broker will do it all for you on the back end. You don't have to do anything. All right. All you're ever going to do is you're just going to see the money. You're just going to see the profit or loss. That's all you're going to see. All this gets done on the back end. Okay. Now let's go over here. Let's talk about how that would work. Let's go QQQ again. Ready? And I'm just going to pick one at random here. We'll go ahead and make sure we sell it. Let's pull up our graph. All right. Which one did I click on? I clicked on the 368, 369. Okay. 368, 369. What I'm doing with this is I'm going to sell a put option at $369. I'm going to buy a put option at $368. Let's see what that graph is going to look like. Okay, you ready? Let's see what we got. Oh, fun. I'm under a tornado warning right now. All right. It says take shelter. I'm not going to take shelter. We're just going to keep going. All right. Don't worry about this funky thing. Sometimes that happens. I don't know why. All right. There. Okay. This particular contract, it's 34 cents or 100 shares, $34. So by credit or my maximum profit, it's $34. Now, this is a credit put spread. It's a bullish position. I want the stock to go up. What happens if I just buy a call option? Okay, let's say I just bought a call option. Let's go over there. Let's just buy some random call option here. There we go. There's a random call option. What is the graph look like on a call option? Well, with QQQ at 372, and this is a $376 call option. It cost you $4 or about $412. With that, at 372, if QQQ is at 372 at expiration, you lose money. If QQQ goes up to 374, you lose money. If it goes up to 376, you lose money. If it goes up to 378, you lose money. This has a break even around $380. So if you just bought a call option, you would need QQQ to get to $380 or more in order to make money. But it's got to go up a lot. What about that spread? If we go back to the vertical spread and we sell the put, I love this stuff, guys. All right, we go sell the put. Check it out. Whoop. Then what happens? All right, where's our profit loss? I want the stock to go up, right? Let's say it goes up to 374. What happens? I get my max profit of $34. Let's say it goes up to 373. I get my 34 bucks. Say it goes up to 400. I get my 34 bucks. Let's say it goes flat at 372. I make 34 bucks. Let's say QQQ goes down a little bit to 371. I make 34 bucks. Let's say it goes down a little bit to 370. I make 34 bucks. The only way I lose money on this is if QQQ goes down. If it goes down to 369 or lower, I'm going to lose money, but it doesn't matter how low it goes. My max loss is $66. Now, this is so cool. Watch this. If QQQ goes up a lot, I make money. If QQQ goes up a little bit, I make money. If QQQ goes flat, I make money. If QQQ goes down a little bit, I make money. The only time I lose is if QQQ goes down a lot. So that is the benefit of this. I have a far bigger chance of making money than I do of losing money. But because I'm taking on a lot less risk, I'm also lowering my profit potential. All right. Hopefully all that makes sense. If you have any questions, throw the questions in the comments because we're about to end this training. There's one final thing I want to show you, and that is what happens if you adjust the strike prices. What I mean by that is, what happens on my bullish credit put spread if I go further out of the money or further into the money? What happens? All right. The further out of the money I go, the more likelihood I am to make money. Since I'm taking on less risk, my profit potential is going to go down. The closer to the money I get, the less chance I have of making money. Because I have a lower chance of making money, my profit potential is going to go up. Let's see what that looks like. Let's say I start going down in strike price. Notice what's happening. Right? Let's say, so up here we were at 368, 369. If I go from 368, 369, max profit 34, break even is about 369. Let's say we start going down. Now we're all the way down to 359, 360. Max profits all the way down to 14. Max losses increased to 86, but instead of breaking even way up here at $369, I now get to make money all the way down here at $360. So by significantly increasing how far QQQ can go down and I still make money, I've lowered my profits, but I've significantly increased the likelihood that I'm going to make money. Now, if I go the other way, let's say we get closer to the money. Let's say we go all the way up to 372. Well, now I've increased my profit to 42, but now I need QQQ to go up to 372.58 before I'm actually going to make money. So the closer to the money you are, the lower the chance you have of making money, but the higher the profit potential. The further out of the money you are, the bigger the chance you have of making money and the lower the profit potential. Okay. Let's head on over. Hopefully all that makes sense to you guys. If not, let's get these questions answered because we are about to end this training right now. So let's go ahead and head on over and see if you guys have any questions whatsoever on any of this stuff. And let me just get this pulled back up here. Hopefully I don't get hit by a tornado. Let's see, where were we? All right. Let's see if you guys got questions on any of this. And I got to go just in case I got to get shelter or something. All right. All right. I'm just going to pull up. Let's see what we got. Any questions at all? I just got some comments. All right, guys, I don't see any more questions. So we're going to go ahead and end it here. I want to thank you guys for joining this training. Don't forget that you can go ahead and get into the coaching program if you want to. You got to get that done, like I said, pretty soon. All the spots are filling up pretty fast. Just go to weprofitdayandnight.com, schedule a call with the onboarding specialist, and don't forget to hit the like button, subscribe. Thank you to everybody that sent these super chats. I really, really appreciate you guys. You guys are absolutely amazing. Thank you guys so much. If you are subscribed on YouTube, don't forget to hit the bell icon and click all. Otherwise, you will not get notifications of this. And if you want more training like this, make sure you jump into that coaching program, weprofitdayandnight.com. Thank you so much for sticking around to the end. I know this was a long event, but hopefully